Emotions have no place in deal making. Well, that used to be the case before Mark Rampolla proved them all wrong. See, what if I told you that your feelings are actually the most powerful due diligence tool in your toolbox? In the next 60 minutes, I'll reveal how top-tier investors like Mark are transforming billions by understanding the psychology behind every investment and how you can do the same. All this and more coming right now. Here we go. Mark, welcome to the show, man.
Ryan, thank you so much for having me. I'm a super fan of you and the podcast and the community. I feel like I'm talking to my people. So thanks for having me.
Oh man, you are talking to your people. It's a treat to have you, man. You've pioneered the coconut water industry. You've done deals with Coke, and you've built a $600 million fund. This is absolutely phenomenal. We're in for a treat. So let's jump right into it, man. Having built ZICO and then transitioned into running a fund, what operating instincts from the founder world actually scale in institutional fund management, and which ones must be unlearned immediately?
Yeah, great question. Oh boy, let me think about that for a second. What I would say that translates well is, as a founder, as an operator, I was good and able to see, and I think most founders and operators are, understanding what's a fad and what becomes a trend. And to be able to catch that at the right time, really think about that timing of a marketplace or a consumer development or whatever it is and get that timing right. I think pattern recognition, investors have that in certain ways, but I think good operators and entrepreneurs really understand how to look at a marketplace and understand the patterns that lead to successful brand building. I would say team, investors obviously understand how important that is, but there's nothing like being an operator to know and be able to assess someone quickly, not just the leader, but the entire executive team. And the last thing I'd say is, look, we're used to having skin in the game. We put it all on the line. And there's nothing like knowing that when you go in, you go all in, right? At the same time, some of those things definitely were challenges for me. And I'll own that. And I see that they're challenges for other entrepreneurs. And I'll start with the last one. In some ways, because I'm so used to going all in, right? Committing myself for, a decade to build ZICO, I have the blind spot of, proverbially drinking my own Kool-Aid, right? I'm in it. I believe it. I'm going to stick with it. Where investors tend to be very rational about knowing when to step back, knowing to walk away. That took me some learning. I also, one of the biggest challenges I had is I tended to see any situation as an opportunity and to think that I could fix it, or at least it was fixable, right? Because entrepreneurs solve problems. We dive in, we figure it out. I've learned smart investors have a very different view on that, right? They assume things are going to get worse. They assume that problems don't get fixed, right? And I think that's a very healthy level of skepticism. I'd also say that, entrepreneurs tend to act very quickly. You got to move, you got to act, you got to make decisions. Even investors that claim to move quickly, they do their diligence. So when we do our diligence. That took me some time to understand. That's usually at the size of checks we're writing. That's months, right? And we will not go forward until that diligence is done, where entrepreneurs tend to move quickly. So it's taken me some time. And I think it's been a humbling realization that the reason why professional investors exist and why not a lot of entrepreneurs make that leap successfully.
Yeah, it's definitely a coliseum, man. So respect to anybody who's been able to do it, and you're one of the best, brother. I really appreciate that.
I'm still learning every day. So let's talk in a couple of years.
I love it, man, and we certainly will. A lot of running funds as well as entrepreneurship, but now you're in the fund game where you've moved from operator to owner, somewhat. So when it comes to both of those, there's always this big R word called risk. And when we're managing risk, this is an important part of asset management. And so you, with your early days of doing deals with ZICO and Coke and rebuilding the brand, a lot of this has to do with risk. And when you're in as an asset manager, a lot of them is you're actually a risk manager. A lot of people would see that. And I find raising capital and running assets tends to go a lot better when you come from the place or the identity as a risk manager more than an asset manager. And I understand it is a very subtle nuance, but it's also quite important. So how do you underwrite risk when returns are measured not just in IRR, but in systemic health and planetary impact? Like, I guess what I'm asking is, what trade-offs have you learned to accept, and where do you refuse to compromise?
First I'd say, Ryan, look, you nailed it. Again, this is something, it took me some time as an entrepreneur to realize how critical risk management is. And so fortunately, I have a partner that comes out of the finance world. I've built a team around me to complement, and I've learned a lot about assessing risk and minimizing it at every turn. Now, we do take a dual focus. We are interested in impact, and we are focused on planetary health and personal health and wellness, like you mentioned, but we will not compromise returns. And so those are secondary, meaning the impact metrics. Absolutely, our primary focus is this a well risk-adjusted investment? Can we generate the returns? Do we understand the risk profile? Now, that being said, what we found is very interesting is often when we go into diligence and look at both lenses, we'll do the business diligence, and then we do an impact assessment. It's a very structured process with very clear processes and guidelines, very much like any other element of the due diligence process. But what we realize is very often the risks that we identify on the impact side are also business risks, because they're the same often today, particularly in the spaces we play, food and beverage, right? So you think about, we go to a depth of supply chain way deeper than we would if we were only looking at the financial risks, because we're looking at secondary and tertiary impacts to understand what's the supply chain look like in a few years? What are climate risks to the supply chain? Is this business mitigating its carbon emissions, primary or secondary? And through that's cost reduction, right? And so it's helped us to get smarter and deeper in the businesses that we invest in. Now, when it comes to the impact side, we clearly understand that there's complexity around these measures, right? The measurements are not ideal. They can get a little sloppy, tracking emissions, figuring out supply chain certifications, all that. My view is we are where accounting was in the Medicis, right? It's beginning to learn to account for these things, but it's not going to take us 400 years. In the next decade, we're going to get so much smarter on how to measure and communicate these. And I'll share with your audience, you may have experienced this as well. Whatever's happening in the political landscape is somewhat irrelevant. Institutional grade investors want to know what they're investing in. So the impact tracking we do isn't so much yes or no, it's transparency, right? So we share impact reports, we measure, so the investors understand the underlying assets and what impact they have. There's certain things we don't compromise on. If a business has a demonstrable negative impact on health and wellness, we're not going to make the investment. If it's got a demonstrable negative impact on the health of the planet and climate impact, we're not going to make an investment. We want to back leaders that are at least open and aware to question their impact. So for one of the early diligence questions we'll ask is, tell us about your supply chain, right? And the leader or entrepreneur that says, oh, well, look, we co-pack, with this person, it's co-manufactured. So, we rely on them for everything. We're out, right? We're out. We're going to go way deeper, but what we want to hear is somebody that says, look, we've got some challenges in our supply chain. One of the things we do, we understand where it sources. We've been to those locations. We look back into that. And just so you know, what you're going to see is we've got some questions about the impact and the employment practices that our third-party provider is using in this country, right? Oh my God, amazing. They're thoughtful about it. That doesn't mean it's a no for us. It just means we have a partner that at the leadership level is aligned with how we operate. And the final is transparency. We want to work with companies that are open. We require certain reporting of impact measures, exactly like we do quarterly financials and other measures of the business. But if we have those relationships, then we feel like we're managing the risk and also, maximizing the return.
Brilliant. So I love that you pay attention to the externalities that exist, both on the upside and the downside, or positive and negative effects. And that it tends to set the bar of what is above the bar and below the bar, or above the line, below the line. And what we're talking about in this particular case is really an in-depth discussion on impact investing. I would say, you didn't say that, but I would say that is to say, here's how we look at the world. If you want to be someone who has purpose and profit, that invests in people, planet, and prosperity, there are certain things that you have to be okay with and certain things that you absolutely are not, which is otherwise called a business. And so you could say, here's how we like to do business, the way that we like to do business. And part of that is we are established in a particular way that we will deploy our assets that make things better in the following areas. And then that defines culture, that defines trade-offs, that defines what you find valuable or not valuable, what you find acceptable and not acceptable. And so impact investing, that was my first love, guilty as charged. And I love this industry. And the ability to say, how can I use my connections, my resource, my attorneys who structure my funds and the great capital markets of America and around the world to really drive change, right? I recall a story in the 2008 recession. It was from Tony Robbins. And this thing happened and it was a recession. He said, how can I help? He was telling a story about his new book. And he said, what I realized is the greatest asset I had was access. I had access. I had the ability to bring people together and to do something positive to counterbalance something that I didn't like to see, which was a big recession and people losing their homes. Not fun. And so the impact investing and setting the bar can also start to define your own industry. Anything you can add to that?
Sure. Look, I think it's been a fascinating journey for us. And I think what I would say is we do walk a fine line because impact is in the eye of the investor, right? How they measure it, what they care about. And we've learned that what we thought was important is not as important to all investors. European investors tend to care very differently about things from US investors and Canadian investors, right? And so what we learned is be who we are, know who we are, be where we are, who we are, have a clear strategy. And the beauty is that our impact is baked into what we do. And so it's not, we for many investors, we don't fit in their impact bucket, right? And this is one thing, but I think for people, raising funds, it's important to understand institutional investors have buckets that they think about portfolio allocation, right? Impact is often a bucket. We've found that is interesting. It can open up a lot of pools of capital, but at the same time, it can be limiting in the execution. And so we consider ourselves return-focused investment firm. We focus on better for you, food, beverage, brands, and the supply chain that supports them. That ladders up to a very positive impact. But it also allows us to capitalize on certain opportunities that might not tick every single box on it, right? And so, but where it aligns is it allows us to attract companies, to attract talent, to attract partners that value this in addition to the investor. So, like you said, this is just the way we're choosing to do business. There's enough investors out there, as long as we can deliver the returns, that we're confident will continue to back us.
I love it, man. It just reminds me of this good old saying that your vibe attracts your tribe. So it's really cool that you shoot that flare in the sky and say, hey, like if this is what you're into and we're into, and if you appreciate health and improving things a little bit for people and planet, there might be something here for you.
Exactly. My catchphrase for it is do good work. The rest will take care of itself.
Ooh, I love that. All right. I might steal that, brother. So we mentioned earlier that not only were you a pioneer in the coconut water space and you launched ZICO and then you did a reacquisition of ZICO. So this is cool. I love talking deals, man, because there's so many cool lessons that are found in it. Walk us through the reacquisition of ZICO. So if a fund manager wanted to pull off a similar buyback from Big Food type of transaction, what structuring tactics and negotiation levers would they need to master?
Wow, great question. Well, look, I think the first thing I'd say is what's unique about this is they're all unique. Of course, every deal's got a certain level of uniqueness, but I think I can identify a few things that would be common because actually we've already applied that. We have another investment in our latest fund where we acquired 3 brands, including one from Nestle and 3 that were PE backed, and are putting them together as a roll-up platform. So we're already learning these lessons, and I think picking up a little bit of a playbook that, look, I'll share this with you, Ryan. You've become a friend and I like the community, but I think we're going to build this into quite a playbook, and it's not fully fleshed out. But the first thing is, recognizing that there are a lot of let's call them orphan brands and big strategics, right? They go through waves. They acquire, they build, they divest, right? And so we're at a time where, at least certainly in our space, food, beverage, food service, food tech, this whole arena, we're at a place where the big guys have been growing through pricing, not through volume. And they're going to get to a point where they've got to start to rethink that. So that's what Coke was ahead of the curve. And that way, they made a decision to sell off or shut down 200 brands global, 200 brands. ZICO just happened to be one of them. So the first thing I'd say is learn to spot the orphans. And I actually do know some firms that specialize in this. They identify brands within corporations and go specifically after them. So knowing what you're looking for, and it's got to be, maybe I would say there's worthwhile orphans, and there's orphans that, might be left better alone, right? So be good at spotting. The second thing I'd say is you got to build really good, I'm not going to say, let's call it insider knowledge, right? Like some knowledge that is unique to you and your strategy that frankly, even the team running the sale process might not know, because my experience at Coke, our experience at Nestle, the groups that were selling these brands, they're the M&A group. They don't have a clue about the business, right? Maybe not a clue, but they have some clue, but they're not the actual operators. And so you got to go deep. You got to learn everything you can around that. And frankly, if they're orphan brands, they're probably not the peak M&A professionals either. It's probably been delegated to someone that's a good professional, but probably younger in their career. And so the ability to know what's really going on is powerful. So for ZICO, even though I had been involved with the brand for 6 years, I knew nothing of the details. Obviously, I had quite a bit of knowledge, but it was outdated. We very quickly got up to speed. Everything that's going on in the market, what the supply chain is. Our diligence was we knew more about the supply chain in Asia, 10x, than the people that were selling the brand did. That gave us so much leverage. Not leverage to necessarily get a better deal, but leverage just to understand, is it worth it? Where might there be pain points? How do we negotiate this? And I'll get into what that means structurally for, as well. The third point I'd say is figure out what matters to the seller. And you'll figure out what matters to you, but spend the time to really probe what matters and what matters behind what matters. What's the need behind the need? Because it's easy to say it's dollar amount, but it's probably not, right? For Coke, whether this was, they got to get the best price they can, but whether it was, 50 million or 5 million is irrelevant in the scheme of things. But what mattered to them when we really probed was three things. Certainty of close was a big deal. They wanted to know that we get this done, it's done. And the other one was, this was very intricate in this situation. It turned out, and there's always situations like this, it turned out that they had some exposure in Thailand because this business entity actually owned some assets that the business in Thailand didn't want to have to deal with. So without getting into the weeds of it, we were able to create a structure that met their concerns in Thailand, allowed them to check a box that they limited their liability. And that allowed us to put in an offer that we knew was just at kind of the minimum we needed to be and get it done. And along with that process, I'd say, like we say on the selling side, on the sell side, people buy brands, not companies. Always about the people. It's the same on the selling side. So I got to know, head of M&A, the whole team that was involved in this, the legal team, the deal team, the finance team. I got to know them and I spent time with them. That sort of human-to-human connection was so helpful to really understand what their objectives are, which in this case was, frankly, get it off their plate because they got other big things to go deal with, right? So make their life easy, make it simple for them, allowed us to get a better deal than we might have otherwise. The other thing I'd say is this isn't so much in the structuring, but it is in the execution. Right team, day one. So months before we closed, we identified the team that was going to run the business. If you're pulling this out, it's probably not going to come with anyone. And so that team was side by side with us in diligence and execution of the deal. So they knew what they were inheriting down to the, AR, the AP, what was viable, what wasn't, all the, the transfer agreements that were going to happen so they could own it day one. And on the flip side, we didn't do quite as good a job on another acquisition we did. And that was a challenge, right? It took us some time to correct that mistake. So I'd say no on day one, what you're doing. And the last thing I'd say is less is more. ZICO had at some point, I don't know, when I sold it, it probably had 5 SKUs. When before we bought it, they probably had 20. Once we bought it and we bought only the brand, so we had to actually rebuild the whole supply chain, we simplified. We had 1 SKU. That's it. 1 product line coming out, made production, manufacturing, logistics, selling, everything super simple. So that's what I would say is the playbook.
Wow. So we got people, we've got products, we got brands. As I like to say, people work is more important than paperwork. And so you hit it spot on, brother. I really appreciate you bringing that up. So when it comes to, let's say, the operational side of things, where just capital can by itself may not be as effective. What signals told you that just capital wasn't enough, and maybe what interventions needed to happen to move the needle?
Yeah, great question. I'll kind of talk in general for a second and then give you a specific example. But I would say back to kind of knowing who you are and being clear about what that is. We pride ourselves and position ourselves as basically bringing best-in-class private equity capabilities to growth stage investors that don't want to lose control. And so what that means is we have the ability ourselves, but also through operating advisors, through our extraordinary network we have, to help companies in almost any area of their business: organizational development, go-to-market strategy, branding, supply chain, people, finance, et cetera. And so it depends on the needs of the business. And the businesses we're backing, they're growing. They're successful already. They more often than not have great leaders. So it starts with a real honest conversation about where they think their challenges and needs are. And we do our own work to see if we agree or not and to see if we're aligned. And more often than not, I think having been in that seat, and my partner as well was a founder, we can have real conversations like, look, hey, you think your sales team is really strong? We're not so sure, right? So can we introduce you to somebody that we think is world-class to see if we're aligned that maybe this is the kind of team and structure you can make, right? And somebody says, oh my God, yeah, well, look, I thought I knew what world-class is. Now I see something different, right? So we'll typically align in advance on where the areas are that we see opportunities, where we see need to address. And then we build a plan, 100-day plan out of the gate, right? And so it varies by company, but I'll give you one example. There's a company in our second fund called Thrive Organics. It's a little health shot, 2 ounces. They sort of pioneered this new category of, these sort of fresh health shots. And, when I met the founders, they were 3 young guys, sampling in Venice Beach. And I, even before I invested, I'll spend time with founders and, give them a little advice and listen and see how they're operating. My encouragement to these guys was they were considering rolling out nationwide at Whole Foods. They had never been in a business like this before, and they were all in their late 20s, I think. They had an opportunity to roll out to Whole Foods nationwide. And I said, why bother? Like, your business is teeny. I think they did $500,000 the previous year. If you can't figure out how to be a $5 million business in Southern California, something's wrong. If you can, you may have the tiger by the tail, right? They came back in 6 months. I said, inch wide, mile deep, like focus from each other. They came back 6 months later, and they were showing me a chart of velocity. That's our term for units per store per week, the rate of sale in a store. And the industry typically measure that's in units per store per week. I looked at the chart they had, and at the bottom, and they were saying around 6, 7, 8 units per store per week, which is okay. No one's felt laying the world on fire. I looked at the bottom, and it was per day. So I said, look, we should have a conversation. Get out of the meeting, called my partner and said, we're going in. Like, we're doing investment. That being said, they had a skeleton team, young, a lot of passion. And so we played a role over time in helping them build out their whole organizational structure, basically. The board, it started with a board. We helped recommend and bring on our board members, hire CFO, CMO, head of sales, and a couple other roles, I think. Help them think about under each of those functions, what the structure would look like. Help them think about route to market. Are they going through which distribution network? Brought in advisors that could help them look at their product line, innovation roadmap. What else? Comp structure, incentive plans, annual OKRs and routines and that. Like I mentioned, some branding work a couple times as they were growing, needing to rebrand. And then we played an intimate role hand in hand with one of the co-founders was the CEO in helping to chart an exit plan. When do you exit? Do you wait for something big? They got approached. We had some conversations with bankers and supported that process. And at the end of the day, they got an unsolicited, help them structure an agreement. Pepsi was a minority investor. How do they have rights? Where do they not have rights? Whole Foods was an investor. So we helped with all that process. And then ultimately, I was sort of side by side with the founder in negotiating with a private equity-backed roll-up platform that wanted to acquire them. How much stock, how much equity, what valuation? How do we do reverse diligence on them so we understand what we're getting? The board decided to proceed with that. And then, we've played a role in supporting the founders afterwards, being advisors, getting different roles, consulting with us on some companies, in their own journeys. And they're still part of our ecosystem. You know, we that's the way we like to operate. We've got founders have become board members have we backed them in other businesses. So we try to create this ecosystem that ultimately helps all of us benefit. And yeah, the benefit is we get to capture the returns and benefit our investors along the way.
Wow, brilliant, man. So you really dove into Vive Organics. That they're lucky to have you. So you can see that, and myself included, that doing a lot of these things, it's not just cutting a check and high five, see you in a year at the board meeting. It's like you really got to roll up your sleeves, and this is how the best of the best do it, in my opinion. You roll up your sleeves, you really push your hands into the soil and get to know this thing from the roots. And then you become that savage servant and just say, how can I serve you? How can I help you? We all want this thing to succeed. I'm now technically one of your partners. If I cut you a check, let's really get this thing over the line. And you can see now when you do these deals and you have a more hands-on approach, the odds of that succeeding goes way up. And by the way, that's what our investors expect. Anything else you can add to that?
Yeah, I would add one thing would be to know when to get out of the way, right? Know what you don't know. As an example, as deep as we are in Vive, that's not the case with all investments we make. As an example, we're early investors in Liquid Death. It's not a thing we can help them with on marketing. Not a thing. They're geniuses. They're crushing it. Now, when it comes to transferring the supply chain and thinking about the logistics of that and which co-packers to work with, and yeah, we can be helpful on that. But it does vary. But I think the approach is, I love that. What was your term for what kind of servant? The
savage servant.
Savage servant, right? And part of that is knowing when to get out of the way, when other people can be helpful. And for me, that starts with asking questions, right? Not assuming, having the humility to really, really ask and probe. And there's a time and place to lean in. There's a time and place to get out of the way.
And that's right. And being really clear on that, I imagine strategy comes into a big part of that, where everyone's aligned on the strategy or approach to whatever it is, marketing strategy, revenue growth strategy, cost-cutting strategy, whatever that is. And, that's not just companies. Many funds also struggle with strategy drift. So I'm curious, we could talk about how you decide to broaden GroundForce's mandate into ag tech, supply chain, decarbonization, and how do you prevent the dilution of Thesis?
Yeah, it's a great question, Ryan. And for us, this has been very pertinent over the last few years because we started the firm as power plant partners. We were only focused on plant-based food and beverage, predominantly consumer-facing, and relatively small first two funds at around 42 million and 160 million. And that was our strategy, and it worked. We were early in Beyond Meat, Peel Sciences, Ripple Foods. We had some really good early investments, and it seemed like we were geniuses, kind of ahead of the curve. We caught that time right, but fairly quickly we started to realize, okay, this space is getting very competitive. There's a lot of expectations. This is going to be $1 trillion market, massive amounts of capital pulling in from sovereign wealth funds. Most major venture funds in the U.S. had somebody looking at plant-based, so started getting competitive. And there were also some signs that the consumer base was not quite as responsive and adaptive as the projections were earlier on. So we started to think that we might need to both pivot, but we also saw it as an opportunity to expand. And one of the things we realized is that while plant-based was our strategy early on, we came to see it as a tactic, meaning that the real strategy was health and wellness and sustainability. And so those two, we could achieve them through plant-based. We could also achieve them through other initiatives, right? So we started to expand our scope and think about not plant-based, but still health and wellness and sustainability focused. We also expanded our scope to allow for beauty and some other consumer products that were very similar, face similar trends, similar challenges. And we gave ourselves, or requested from our investors, our LPs, the ability to start to do some supply chain investing. And the theory there was, we are so deep with these companies that, serving on the boards, getting involved in the operations, we know what they're struggling with. And we see the movement in the near-in supply chain. So we did consider for a while, would we do ag tech? Would we do kind of further in the food supply chain? But our conclusion was, we don't have the expertise. We don't really have the right to win. It doesn't fit with our core DNA. Our core DNA is deep operations and deep knowledge of consumer-facing brands that does support 1 degree separated in the supply chain. So when we're looking at ingredient companies, co-packing technologies, packaging alternatives, those are areas where we can understand quite well. And so our criteria was, is it still growth stage? They still have the same challenges. And then we had a sort of simplistic way of evaluating this. Can we speed dial 10 to 20 people instantly that can help us diligence this company? It could be customers. If we can answer that, then it's fair game for us. So it was an expansion in scope, but a rational. And equally, as you know, LPs get very concerned about scope creep and also dollar creep. Right? It's easy to go say, I'm going to go from 300 million to, or 150 million was our second fund, to $1 billion fund. It's a big gap. How you underwrite, the kind of businesses you underwrite, how you invest that. So, we were very rational in saying, look, the same strategy, we could take it up, we know, to about 300 million or so. And we understood what the portfolio distribution would look like and all that. And so we went from a $150 million fund to a $330 million fund. And we're doing that same work now, thinking, okay, where do we go? How far? Do we want to expand or not? We don't feel like we need to expand much at all to get maybe a slightly larger fund to allow us to do slightly bigger investments where typically we thought we were going to be writing sort of $15 to $20 million checks. Now we're fighting to lead and control certain deals. We've got to be able to write $30 million checks. And so the math may necessitate a slightly larger fund, but still we're very, very clear on what our strategy is and believe that's helpful for us to win, but also LPs really want to know that as well.
I love that. It's almost like you can't, like you said, you can't just stop at product, and it's building that infrastructure beneath it. So you can see how it's actually not diluting your thesis. It's expanding on it, is to say, sure, there's supply chains and they need the right materials and avoid the wrong materials and have the right inputs, right? I come from oil and gas, so we call it throughput, right? So there's a lot of materials that go in and they go through their industrial process and they create something quite useful that people need and they want. Now, in your case, and I hate to put you in the same place as oil and gas, those are very different industries. We're just talking about industrial processes, thinking all the way through from the natural source to the finished product, instead of just finished product. So it's almost like building the proper supply chains and the proper supplies to fund that regenerative food climate or a lot of this health and that impact that you're looking to make.
Yeah, you just health and wellness, right? Yeah. So like the brands we're working with, they're all, I'll give you one example. One area we're interested in is testing. And the reason is because every one of our brands has to spend quite a bit of money on regulatory testing, compliance testing of their products, right? So they use these services constantly. We know who the players are. We know they're slow, outdated, and not always reliable. And if you're down, if you have a problem, you're out of production, right? So it's an area we know well. We've spent a lot of time in it. It's a pain point for these companies. So that's an area where we think, look, if we can find the right investment, we think we can diligence it properly, add value to it, and then also help them sell immediately because we can open a Rolodex. I will add, though, we also brought in a partner that's dedicated to space. So in addition to doing our own work, doing 2 years of research before we did our first B2B deal, we brought in somebody that's an expert. They've done only B2B supply chain deals in this space for 15 years, right? So it's equivalent to almost a separate manager. And that's the investment we were willing to make on our side to expand this area.
Oh, man, that incredible work, man. You really thought that through. I'm reminded of the first time you and I met, and we really hit it off where we talked about our appreciation for meditation. Talk about your vibe attracts your tribe. So I told my wife, I was like, man, I think I found my new best friend. And, but in all seriousness, one of the things as we really got into the importance and the benefits of that and, personal and in business and a lot of great people in this space, Ray Dalio is a big one in meditation as well. Now, one of the things I learned from you is that you said emotions are data. And that is something which is not, I don't know if I want to use popular, but it's maybe not as appreciated. My impression is it's not as appreciated in a very quantitative field like high finance that we operate in, but yet you bring that in. So these are one of the cool things that you bring in your firm and to this industry is that emotions are data. So my question is, you can talk about how you operationalize emotions being data. How do you operationalize that into diligence? And maybe talk about any frameworks that you use to evaluate founder psychology or and really, would you ever pass on a deal where maybe the numbers work, but their psyche didn't? I'd love to hear the emotions as data framework that you have.
Yeah, great question. I love that you picked up on that. So yeah, look, and that's actually the reason I wrote this book is to help, first of all, founders, but it's very applicable for investors at all, understand how in many ways, basic psychology. I had a good friends read this that said, oh, this is psychology or therapy for entrepreneurs that will never go to it. And so one of the things I came to learn is from the time I first went into the business world, I heard like everyone, it's no place for emotions, it's numbers, only rational. And I've struggled with that for years until I finally did some research on this, both neuroscience, psychology, and a variety of other fields. And I came to see when did emotions get this bad rap? Like they're just energy moving through the body. They're just the way the human body experiences the world. Nothing bad about them. There's also nothing necessarily great about them. Like anything, when they're not understood and properly managed or contained, absolutely they can sway us. But you're telling me rational investors have never made dumb decisions? Come on, like you can look at the numbers and interpret it a lot of different ways. And so what I've learned, and this is particularly dealing with founders, with operating businesses, is the reality is it's an emotional experience. It's a full-on experience. So emotions occur, right? So let's just call it what it is. We have, and they're there. Now the question is, what do you do with it? And what I've come to learn is, and I do walk through this in quite some detail in the book. The first recommendation I have is feel all the feelings. Just feel them. Get used to them. I recognize early in my career, it's almost like I consciously cut my head from my body. I'm going to live only in my head. I'm going to analyze. I'm going to think. I have no body. I have no room for emotion. Meanwhile, I'm making tough decisions. I'm dealing with partners. I'm dealing with people. So I have these emotions going on. So the first step for me is just acknowledge they're there and that there's nothing wrong with them. And then potentially there's data. There's this incredible thing called intuition that when well honed and well respected is probably only right about 100% of the time, right? When you look back and say, oh, I had a feeling something was off there. Why wouldn't a rational, intelligent investor want to get all the data they can? So I'll come to what we do with founders, but let me start with what we do internally, which I think is in some ways even more interesting. So in our investment committee, we might be, if we're getting serious in a deal and close to closing on the deal, we might have done 3 months of diligence. We might have a 100-page memo. We might have spent hundreds of thousands of dollars of our money to do the work on diligence. And so we're looking at the data, right? We're looking at the data 75 different ways. But at the same time, it's a long process. There's a lot that goes through it. And there's other people on our team that haven't necessarily been in every step along the way. And so what we do is, as a matter of course, is we take a step that we just call a check-in. Does anybody have any unsaids or any unfelts about this deal? And it just creates a little bit of space, because even the brightest, professionals tend to get attached to something, right? They feel emotional about it. They've done a lot of work. They get to know the founder. They get to know the team. They want to get a deal done, right? This just creates a little bit of space for anybody to say, you know what? I'm not on the deal team, but I did meet that founder a couple of times. I don't know. I just have some questions, right? About this, that, or the other thing. Doesn't mean we don't do the deal, but at least I want to know if somebody's got some intuition. They're a professional. They've been working in our firm for a while. They've met with a lot of people. If they got, I really wonder about that consumer base. I really wonder about this person. We want to know. And then it's a chance for the deal team to say, yeah, look, it's a great question. Here's why we concluded what we concluded, and look at the hard data and see if there's a gap with that. Maybe that bridges the gap, maybe not. Now, again, it's just additional information. It's not swaying the process, but it's there, so why ignore it? Now, how does it apply with evaluating founders? So we spend a lot of time going really deep on evaluating the leader, founder, CEO, whatever the leader is, and usually the executive team of the company we're going to invest behind, because it's a big deal, particularly in the growth stage. You're not backing scaled, super profitable business where you could effectively replace the leadership at any time, right? These are growing, living companies that require that attention, usually of that leader for some period of time. And so we have a very rigorous process we go through. We have a CEO assessment process we go through. Some of it's quantitative, some of it's qualitative. And it's through a series of interviews that we do and conversations. And then typically before, if we're writing a larger check into a major, for a sizable portion and position in a company, we will ask the founder, and it's pretty much required, to go through a personality assessment. And this isn't only a Myers-Briggs or something like that. I'll share a name. It's not our own company, but it is I think an extraordinary resource. It's called Hogan. It's a world-class assessment organization used by Fortune 50 companies on assessing their talent. It's expensive. It's thousands of dollars. It could be probably 10,000 or up to do a real assessment. But the learning we get is incredible. And we share it with the person as well. It's an outside world-class research. And it's not good, bad, right, wrong. It's what kind of leader is this? Where might they challenge? Where do they excel? Because for us, it's as important to understand, does this person have the self-awareness and the interest to learn where they have their limits, where their challenges are, where their strengths are, what we call their zone of genius, and how can we help them spend more time in their zone of genius. We also have a world-class operating advisor that's an ex-chief talent officer at Nike and Mars, and ran a 40-person performance and development team. So we pay him on our dime to assess and work with a leader, helps us learn, helps them learn, and then very often may even get involved to help coaching along the way. We recommend, we don't require, because most of our CEOs have coaches along the way to help their own development, and we do really deep reference checks. One leader for one company that we were considering, I personally did 13 reference calls, 13. And I'll tell you, they weren't all perfect at all. In fact, one of them was negative enough. I got worried, but then through other calls, I realized it was a good negative. They had pissed off someone because they held firm on something that was rational to hold firm on. And we were to validate that, right? And so, to have the simple answer, if we're not feeling great about the person, we're out. We're out. It's a marriage, right? This is a long-term commitment. So we want to know who we're getting involved in. And for us, it's way better to pass on a potentially great deal than it is to do a bad one.
Brilliant. Wow. So understanding that psychology, not just with the people that you invest in, but the partners that you take on, as well as inside of your firm, that is absolutely brilliant. So as you can see, this is a very important part of operationalizing emotions as data. Would you agree?
Yeah, absolutely. And it's not only the emotions. Like we have, and I do walk through this in my book, we use a very thorough process on this for communication, taking 100% responsibility, no blame or shame. When we have meetings, we communicate that way. Brutal, but constructive. Ray Dalio's amazing. I've talked to a lot of people that worked in that organization. Not exactly the most high performing place in a lot of ways for attracting great talent that wants to grow and develop. We spend a lot of time with our team on how they are developing their skill sets. And I get as much feedback more than I get. We ask for constant feedback. What can we do better? How can I be even more powerful to you? And so we create this culture that's just like, it's fast, it's clear, it's dynamic, but it's two-way. It's not only down.
Yeah, and I believe, I could be wrong, I think Peter Drucker said culture eats strategy for breakfast, or something like that. Yeah. So
I will swear by that.
Yeah, well, you would know for sure. From your 2 decades of building ZICO, coconut water, that brand, which lessons are most directly transferable to running a fund, and how do you bake those into GP, LP alignment, portfolio management, exits, all of that?
Oh boy, great question. Great question, Ryan. I'll give you a few that come to mind. One is you got to play in big enough markets, right? I think it's easy to forget how important it is to have a big enough market that you can play in, both to grow your businesses and for an acquirer to grow the business, because it's not just your period of time. You got to think for the long term. The second thing I'd say is, as a founder, I certainly understood this, and as an investor, is this business solving a real problem? It's easy to claim it is, it's easy to perceive it is, but is this something when you take it away from somebody, they're like, oh God, I can't live without this, right? Is it real? Can you there's ways to actually measure that in terms of engagement and repetition of the customers. The other thing I'd say is, I learned as a founder and an operator, not every person is right for every role over the period of time, right? My VP of sales early on was not the guy that was going to be the VP of sales eventually, right? I had to learn and grow in my role and expand. So right talent, right fit, right time, right time. And so is this leadership team right to get from here to the next scale of growth, 18 to 24 months? Not necessarily forever. The other thing I'd say, this again, I think probably plays particularly to the growth stage investing and maybe early stage investing. Reconsider everything always. Doesn't mean you can rebuild the business, every piece of the business all the time. But when I look back over my time at ZICO, I'd say every year we had one major initiative around some function. It was either sales, marketing, finance, operation. And therefore, every probably 4 years or so, we touched everything, right? By the time we got back to look, growing from 0 to 10 million, 10 million to 50 million, your operations might need to be completely retooled, right? So we go into our investments knowing that and anticipating that. But the last thing I might say is there's something about starting with the end in mind, knowing as an entrepreneur, where do you want to go with this? How big do you want to take this? Where do you want to exit it? As an investor, it's critical. Who buys this? Why? What's your exit scenario? How do you return capital? What's the optionality around that? At the same time, we do a lot of work on that. Once that work is done, build a great business. You can't control the outcome. Build a great business and the rest will take care of itself.
Man, brilliant. Build a great business and the rest will take care of itself. That I could have said it better myself, man. And that's absolutely brilliant. So when you see founders who are clinging to a vision, and I'd love to get your take on this. When you're working with founders, you're an investor and you're being that savage servant, how can I help you? Is helping you backing away? What's going on? You're also watching these guys. And so when you see them clinging to a vision in the face of market signals, right? So it's the classic pivot or persevere. How do you as an investor decide when to fund that pivot or cut the cord? Like, do you have any frameworks that help you to guide that decision of saying, we're going to support you on this pivot, or I think we need to cut this loose out of our portfolio?
Boy, once again, Ryan, great questions. You're making me realize we've got a lot of playbooks and a lot of frameworks. I don't think we have a framework. I know we don't have a framework exactly for this. We have a lot of pattern recognition. We've been through it quite a bit. What I would say is, first of all, tough, right? This is one of the biggest questions and places where people get stuck. What I would say is that the positive signs for me are when a leader and the team are curious. Of course, they're going to have a bias. Of course, they're going to want to be right. Of course, they're going to have strong opinions. But are they open? Are they open to arguing an opposite view? Are they open that the opposite of what they view could be as or more true? And are they willing to do the work? What I mean by that is, like, when I see a founder team say, look, I think we might need to make a major pivot, right? The consumer we're serving or the product line we're serving, I'm just not sure it's right. Here's where I think we need to go, right? What I want to see is, how do they reach that conclusion? What kind of data are they relying on? And how attached are they to that? Because it's really easy to get attached to shiny objects. It's really easy as a founder, particularly, to move on to the next innovation. And so when a team, a founder, can lay out for a board and say, look, here are the options we're considering. This is the way we're going to evaluate them, and we're going to reach the best conclusion. We think the hypothesis is here. This is how we're going to test. And it could be as simple as asking, are you open to being wrong, right? And if it's as simple as absolutely, like we're going to do the work. Help us think about this process. Then we're in, right? We're in. Of course, we want to see it. We want to do the work. We're not necessarily going to write the check. But when we see someone is overly attached, when we see writings on the wall or not on the wall, or they're not sure. Look, we will pull the cord. We will pull the cord. There's no reason to follow good money after bad. And I will tell you, this is challenging for any investor, myself included. But fortunately, we have some world-class LPs, our investors, and some of them have run multi-billion-dollar funds. And the feedback I get constantly from them is focus on your greater winners. Don't spend all your time saving your challenged companies. Put your best people and your best time and attention on your biggest opportunities. And that's, I think, one of the secrets of success in this business.
Wow, sound advice. So really circle the wagons around some of the best ones that you've got, but also judging back to almost that psyche, that feeling, that vibe is like, what's going on? As I like to say, and I think you and I exchanged notes when we first met, is I believe success is an inside job. And that's not just for investors, it's entrepreneurs. Those are people leading your portfolio company. You got to understand what's going on inside of their head too. And I think what I'm hearing from you is to say, yeah, as long as they're open, that's usually a good sign that they'll be open to pivot or persevere, whatever we think to do. They're more willing to work. But sometimes in that moment, when you get a gut punch, maybe the market shifted, interest rates went up, you're highly levered, whatever it is, you got to know. And as the saying goes, in the face of adversity, a man is introduced to himself.
Yeah, of course.
And so we got to know what's going on. And typically, I think what I'm hearing, and I'm going to steal that and try to institutionalize that as well, is just saying, hey, as long as you're open, we can work with that. Doesn't mean I'm going to keep your company alive. We might roll you off or whatever, but I think we're onto something. And I think you never forget that. There's a lot of people who blew it. They had investors, they invested in their money. I think Adam Newman was one, and they come back and they get funded again. And there's a reason for that, because it tells me there's something other than the capital that investors value. That's what that tells me. And I think understanding what's going on under the surface is precisely that thing. That's to say, do you have the chops and the emotional fortitude or the emotional mettle to pull this off?
And there's times you've got to have those tough conversations, and nobody is served staying in a role where or continuing on a path that's just you're fighting uphill forever, right? And so sometimes you got to make the tough calls, and I've had to make some really tough calls and have some tough conversations with founders that I love, I consider dear friends. And more often than not, later, after we've disagreed with them, and sometimes they were removed, they came to understand it and see it, right? And we've built incredible relationships. They've gone on to be great investors, great operators in other ways. But by and large, we like to back our leaders. We're going to give them the benefit of the doubt. We're going to give them support. We're going to give them coaching. We're going to give them tough love, because founder-led companies outperform. Data's clear.
Yeah, agreed. I'd love to peel that back even deeper, but more from you with the LP example. Early in the days but in recent time, let's say within the last 5 years or so, sustainability and ESG, and there was a lot of these things that were popping up, and it was like this natural iteration of this style of investing. You don't really hear it too much anymore, but there was a thing where there was what was called greenwashing, right? So these are people that just says, "Oh, we're amazing," but again, peel it back, you're not. You just putting lipstick on a sow, And so I'd love to get your opinion, because many LPs, they demand measurable outcomes and sustainability and impact. They want to know not just profit. Of course, they want to know profit. They also want to know, are you reducing greenhouse gases? Are you making the world a better place? They're just checking in to say, are you doing what you said you do? But a lot of times, Mark, the data can be quite noisy. And you mentioned this earlier, saying we're still figuring out how to measure that. We got a lot of things right, but still room to grow. So how do you structure impact measurement so that it's credible, comparable, investable, all of those good things, without falling into those vanity metrics like the early folks did?
Yeah, great question. Look, this has taken us years to work on and improve. We've worked with some world-class consultants. We've talked to, institutional investors across the world about this. And we came to a structure that it's constantly improving, but right now it's fairly straightforward in that we have two pillars that we focus on. It is improving the health and wellness, promoting healthy and sustainable lifestyles, and moving towards a lower carbon regenerative production system. That's it. And so those are guiding principles. So they're not the buzzword, right? They're a little bit awkward in a way, but they capture very clearly what we're about. And those keep us from chasing different ESG words or whatever are, and they're very clear with our LPs what we're mentioning. And then we have standardization with some flexibility. So every one of our portfolio companies reports on a quarterly basis, along with their financials, 3 to 5 sort of institutionally aligned KPIs. So they can vary from company to company, but they stay consistent within that company. Some might be focused on, carbon emissions, some might be focused on health and wellness, some might be focused on employment, whatever that's. And then we use that data then we track the data. So we're tracking that on a regular basis. And those allow us to then customize the KPIs per company, but keep it within a standard. And so we have a regular format that we're reporting on. So it's just not the vanity stats, all that is validated by a third party. So we have a couple outside consulting firms that specialize in these different areas that can help us both before we, even close a deal. We actually have part-time impact advisor that works with us, and then some third-party groups that help us validate the metrics, what's the latest best-in-class standard that's being used by major LPs or major funds, and we apply this. And we'll take transparency over perfection. So we want to know, we want to see it, and we'll report it as it is. And because what we have found is, to your point, I think for a lot of these institutional LPs, they want to know, and they're beginning to understand and get more and more sophisticated, kind of like early in accounting standards, right? And over time, we've become more and more standardized. So let's start gathering the data, let's continually report, and then we'll talk about ways to improve over time.
Brilliant. Holy smokes. So really getting those in place and making sure that those numbers aren't noisy. You also bring in other people. So you have a standard internally, you have a culture around that, and then you also you reinforce that with people who specialize in that. Any names that come to mind for those who are maybe starting their impact fund and who could help them measure that?
What is it called? It's Planet Forward, I think it is, FWD, I think it might be short forward, that does the emission analysis. And there's a group called How Good that does sustainability metrics, particularly around consumer brands. Those are the two that I'd mentioned.
Brilliant. Okay. So How Good for sustainability metrics, Planet Forward for emissions and emission analysis. One of the big things is pitching investors and competing for that capital. And a lot of times you hear this, and I'd love to just get out of kind of the nuances and the jargon and really open this up. And you've been absolutely brilliant. When you pitch family offices or pensions against maybe mega funds, what's the GroundForce edge? Like, how do you position GroundForce as the smarter bet for sophisticated allocators who are likely seeking that uncorrelated alpha?
Yeah, I would say there's two things, but are very related. We're a sharpshooter with deep sector expertise. And so we take as a given, or we talk people through why they should be interested in the consumer-facing and B2B overall global food system, right? So multi-trillion-dollar market, growing, blah, 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 blah. So if they're not interested in that, and some aren't, then we don't waste our time. Right? They have no interest. If they do have an interest or curiosity about that space, then we talk about exposure. Look, you can get exposure to that, obviously, in public markets. In the private markets, there are some big firms that have exposure to the space. So you're getting some exposure through major tech firms to certain aspects of this, right? But they're not sharpshooters. And so I will put ourselves against the best venture capital firms in the world, and frankly, the best PE shops in the world when it comes to growth stage, food, beverage, food service, big tech, mainly in the US, and that are looking for minority investment, not for full buy-up. I'll put us up against the best in the world in that space. And so that's a sharpshooter, that's deep expertise, and we can demonstrate that crystal clear. Does that guarantee results? No, but it means that in this space, in this sector, to your point, uncorrelated, right? Some people hate consumers. Some people love consumer, but it is what it is, right? So we've hit some times that are great, sometimes that are not great. That we can't control, but we can control, and we're going to get into the right companies, and we're going to dive in deep to help them win no matter what it takes.
I love it. So would you say then the sharpshooter with deep sector expertise is a really great way to raise that institutional capital?
It is, if you have it. If you can.
Yeah, it's not BS, for sure.
If that's what you bring. I know plenty of fund managers that take a very different approach, right? And their view is, look, we're not the sector experts. What we specialize in, we've got an unbelievable network. So we're going to coattail funds, right? Like, I know Mark. I'm on Mark's short list. I'm on GroundForce Capital's short list. I'm going to get $5 to $10 million on a couple of their best deals because I'm going to work my ass off to get that, and I've got that across 20 different funds. Interesting strategy, right? There's a lot of strategy. What I came to realize is I'll learn and I care a lot and will pay attention to what other fund managers are doing. But then it's like, how can we just be the absolute best at what we're doing? Let the LPs diversify where we want to be the experts.
Brilliant. Looking back, as we got to know each other the first time we met, I really learned a lot about the things that you've done. And over your career, you've done some really cool stuff. You've raised over $1 billion. I think you sat on over 20 boards or something like that.
Yeah, probably
what
more.
Advice? Yeah, probably more. I'd love for you to talk about some of the advice that you can give to managers who are trying to institutionalize value while also scaling AUM, as well as delivering those institutional grade returns.
Well, look, the first thing I'd say is with all humility, we're still early in our game, right? I feel like my partner, Dan, and I talk about building a 100-year firm. And so we're just getting warmed up. So we still have a lot to figure out, but I'll share what I can based on what I know right now. And what I would say most importantly is it's got to be true for you. It's got to be true for you. It's got to be, one of the things I talk about in my book is alignment, head, heart, and gut. And this is actually neuroscience. It's not just, woo-woo. Neuroscience is very clear on coherence, that when you are aligned a goal with an emotionally charged connection to that goal, and it's aligned with who you are and what you believe, your probability of getting a great outcome is way higher, way out, right? So make it true to you. And I'll give you an example. Early on, and we still hold these key values of health and wellness and sustainability, for sure. Those will always be with us in some form or fashion. But what's interesting is in the last couple of years, we developed a third that's becoming almost even more of a key value for the firm, and that's culture. And I'll tell you what that means for us and how we came about that. I'll never forget my partner and I, world-class advisor helping us do some strategy work. And I wanted to be right. I was health and wellness, sustainability. And my partner Dan's an manages $1 billion hedge fund. He's been a successful entrepreneur as well. So very rational, smart, disciplined guy. And he said, look, I love all that, Mark, but I'll tell you, I just want to be in a culture where everybody wants to be their best. And everybody has the opportunity to be their best. And we're supporting everybody on their journey to be their best. And at first I was like, what does that mean? How do we codify that? What is that going to mean to investors? And then I realized, oh my God, that's absolutely what I want too. And so we went through a process to actually get very clear on what that means to us. And what that means to us is pretty much what Dan had kind of articulated then is, what if we could create a culture that not only attracts the best talent, but this is a place where you can come and realize your full potential, and where we each are committed to helping the other realize their full potential by and through investing in great companies and delivering great return. That's the way we're going to do it. And so, yes, the sustainability matters to us. Yes, the health and wellness. But the thing that's becoming core to our DNA is we want to build the best culture in finance, the best. And that's going to be zero compromise on performance. If anything, it's going to be driven to the core. But the way we're going to do that is radical communication, constant clearing, helping each other, playing our zones of genius, feeling all the feelings. Like we have all these tools we use, and this is everything I've codified in this book I wrote. Again, geared towards entrepreneurs, but we use it internally as an investment firm. And I'll tell you, Ryan, I have never felt more energized in my life. Never. Our team is so engaged because it's like, this is our sport, this is our passion. So this is our value. So make it about you, figure out what's true to you, build your culture around that. Don't compromise on who you bring into the team. And then, do the work to find the LPs, but you'll find the match.
Man, that is brilliant. This has been an extraordinary conversation. So before we wrap things up, my final question. A lot of this in investing is a long-term game. And also one of those things that comes by playing a long-term game. And I believe Simon Sinek calls it the infinite game in business. One of those things that also comes from such a long game strategy, like a lot of closed-end funds are 10 years, right? People are surprised to say, what, 10-year fund? Yeah, bit longer. One of the things that come with that is someone's legacy. That's both for the investor as well as it's true for the entrepreneur. So if legacy is that true scorecard, what capital allocation principles should fund managers adopt immediately to ensure they're not just producing returns, but shaping industries for the next century?
Wow. I like to think that I think big, Ryan, but you're pushing my here. I mean, I do a 50-year plan myself, and now you're challenging me to think infinitely. But I'll have some fun with you on this one. I do think about that personally, and we think about that as a firm as well. And the way I think about that is, particularly with our firm, is we play in the food system by and large, and that system. When I've spent a lot of time to look back on the history of it, the food system we have today was predominantly built post World War II. So, U.S. but around the world, massive disruption in World War II. All of a sudden, you need a ton of people moving around back to their countries. Population takes off. You need calories, and you need them cheap, and you need them clean, and you need them distributed properly, right? So that's how we built our food system. Get cheap calories distributed as widely as possible. And I'm convinced, as are many else, that's one of the reasons why we've got a lot of the health problems we have today. So that's okay. It is what it is. Very smart people, caring, I believe. Let's give them the benefit of the doubt. People built this system, and they built it with those sort of intentions in mind, and it worked. Right, it got us where we are. But that's looking now in many ways, you could take it back even pre-World War II and say that this was in the 1800s. So it's been well over 100 years that really this food system has been built. We look at the major food brands; a lot of them are getting towards 100 years, right, if not longer. So we like to think, what is this system going to look like in 100 years, right? Hopefully, next generation down from somebody on our team is running this firm someday, and they can look back and say, wow, we have played a part in rebuilding this food system. So the way we like to think about that is, first and foremost, we're not around if we don't generate returns, right? So that's going to be fund 35 for us or whatever it's going to be, right? So we've got to develop a flywheel that generates constant returns. In addition to that, we play our part. We don't try to fix everything. So I'm not worried about new seeding systems. I'm not worried about robotic technology to improve seed distribution. I'm not worried about the healthcare system. I'm worried about the food system within the grounds we play, consumer-facing brands in the supply chain that's near into that. That's our role. We fix that part of the problem. Somebody else is going to fix other parts, right? Earn the right to expand is the second thing I'd say. So I'd like to think 20, 30 years from now, we might have a full seed-to-mouth system, investment platform. We may have multiple funds. We may expand in a variety of ways. I would love to do that. We got to earn that right. We earned the right to expand from plant-based to broader. We've earned the right to expand from consumer-facing to just inside the supply chain. So you got to earn that right. I'd also say, be comfortable with incrementality, right? One painful lesson we learned is we did make some early investments in some of our earlier funds, and these change the world type investments. In our space, it would be precision fermentation or lab grown meat. It's going to take, the cost is $5,000 per pound to get it down to be equivalent. It's going to take 20 years and $100 million, $200 million of capital in one company, right? Forget about it, right? We're comfortable with incrementality. So we're comfortable with companies that are just making a small shift. Some other investors have a very different view. They want to change the world, right? That's okay. That's not our game. We know the game we play. And I'd say think in systems, but act in stages. Systems, it's almost impossible to grasp the complexity of the global food system, let alone the global oil and gas system, right? But you can think about the whole systems and think about the whole supply chain, but focus on one stage, one area, one incremental shift. Well, those little shifts add up over time to massive changes in the industry.
Brilliant. I love that, man. Think in systems, act in stages. So before we wrap things up, final thoughts. Is there anything you would like our listeners around the world to know, ways to contact you, where they can get your book when it comes out, all of that?
Sure. LinkedIn's got a best for me. I'm not big on other social media platforms. GroundForceCapital.com is our firm website. I do have a personal website with the book and some of the material I'm doing, markrampolla.co. And yeah, the book will be out releases on October 7th. It's available now for pre-order on Amazon. And I would love to have some of your listeners, order one. I know it's immediately applicable in firms. I know that. I chose to focus on entrepreneurs for reasons that make sense. That's an audience that's important to us. But I'm equally passionate about bringing this to investment firms, because when I think about the impact I want to make, I want to help build more centered, present, free leaders that bring their gifts to the world and help others bring their gifts to the world. And that way, change the world. And there's no better place I'd rather do that than investors, because the impact we have across companies is massive. So hope everyone will give it a read. Love to talk to people about it, because I want to help break down this barrier that there's no place for emotion in investing. Let us live as humans. Let us be free. Let us be free, Ryan.
I love it, man. Bringing that elevated consciousness. So just to summarize everything that Mark and I spoke about, remember, people work is greater than paperwork. The other thing is you gotta make sure that you are investor and team ready on day one. Remember that culture eats strategy for breakfast. The other thing we talked about is never forget that success is an inside job. One of the things I loved is think in systems and act in stages. And finally, just remember, seek to be consistently reliable rather than occasionally exceptional. You do these things and you too will be well on your way in your pursuit of making billions.